Hi, everyone. This is Jason Bjark of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a former hedge fund manager. He currently writes a paid newsletter, the Felder Report. He also has a podcast. Jesse Felder, thank you for joining me again.
Good to be with you, Jason. Thanks for having me.
So, Jesse, we're recording this interview on Monday, June 24th, 2024. The dollar index is up substantially over the last couple months. It's at 105.5. The 10-year U.S. Treasury yield's been a roller coaster the last 9 months. It's back down again to 4.248%, and the gold price has rallied a lot since the beginning of March. It's up to $2,332, although a little bit of a correction the last couple of weeks. I want to get your thoughts first on the large cap tech stocks, the Mag 7 or really the Mag 4 now here in the United States. In the last 6 weeks, they've added about $1 trillion of market cap for Nvidia and Apple each. Have you ever seen anything like this in the past where a company like Apple, and you've talked in your other public interviews with like no growth, it's had no growth for about 18 months, where they suddenly just add $1 trillion of market cap very quickly?
No, I've never seen anything like this because they're already the biggest stocks in the market, and then to see the stock prices go parabolic is really a very unusual, rare type of thing. And I tweeted a stat. Berkshire Hathaway, which Warren Buffett has spent 60 years building, is still less than $1 trillion in total market cap. It's 900 billion, something like this. Nvidia in over a 6 week period added more market cap than in 6 weeks than Warren Buffett was able to do over his 60-year career with Berkshire Hathaway. That's absolutely mind-boggling. It makes no sense to my way of viewing things. Berkshire Hathaway, is one of the largest companies in the world by revenue and assets, and Nvidia has had a absolutely stunning rise in sales of its GPUs as part of the AI boom. But to extrapolate those gains, and that profitability so far in the future, to put a $3 trillion market cap on it is and 40 times sales is something that's more extreme than anything I've seen in my career.
And that $1 trillion of market cap from Nvidia, that was after the stock split, which a lot of companies don't like doing stock splits, but the retail investors seem to have piled in. Or do you think that this is based on maybe managed money, institutional investor liquidity flows? Because in our last interview, didn't you say that a lot of Chinese retail investors and institutional investors were getting out of Chinese stocks and they were willing to pay over a 30% premium to net asset value for access to Mag 7?
Yeah, there's a lot of foreign money that's come in. I think it's been Japanese investors, Chinese investors. But I think that the big thing that drove it over the past couple of months, drove Nvidia and Apple, is an unprecedented amount of call buying, a gamma squeeze where you have an incredible amount of short dated, far out of the money call options bought, which the market makers end up being short a call option. So stock price goes up. To hedge their short call option, they have to buy the underlying. So this is something we saw in 2021 with GameStop and other kind of meme stocks where there was just a crowd of buying into the options market, into call options specifically, and that drove underlying demand in the shares by market makers. And I think that's exactly what we've seen in Nvidia, in Apple over the last month. And it also comes back to an interesting dynamic with the technology SPDR XLK is the symbol where due to just restrictions, regulatory restrictions. It can only have two highly overweighted positions, and those have been Microsoft and Apple for years. And Nvidia has been relatively underweighted. So, for example, Microsoft and Apple have been a 20% weight in this ETF, and Nvidia was only a 4% weight. But when Nvidia passed Apple in market cap and eventually Microsoft, it meant that the ETF would have to take Nvidia from a 4% position to a 20% position, which was a $10 billion worth of buying in the stock that happened by last Friday. So I think a lot of this call option buying was related to gaming the structure of this one ETF, knowing that if they could push Nvidia above Apple's market cap, it would create a bunch of basically synthetic demand from this one ETF that they would be able to sell into. And so a lot of this is just structural stuff related to speculation that I think is just kind of wholly unrelated to the underlying business. I mean, obviously, what got Nvidia going in the first place was this incredible sales growth and things, but it did morph into a speculative frenzy over the past few weeks related to these dynamics.
Yeah, didn't it add about 30% increase in the share price post stock split? I mean, that's really rare.
Yeah, and it's also that's very reminiscent to me of the dot-com mania. Like stocks have not really done stock splits. It used to be a big thing back during the dot-com bubble because stock prices went up so quickly. They'd get into the multiple hundreds of dollars a share, and it would make it difficult for small investors to buy even one share. And so they'd split the stock, whatever, 5-for-1 or something, and take it back down under $100 a share. But now investors can buy fractional shares. And so there's really no reason to do a stock split, which is why they haven't been very popular. But just like what happened back in the 1990s is a stock would split or announce a stock split, and investors would pour into that stock, anticipating the increased retail demand that would materialize due to the lower stock price. And so just people, literally, there's no economic reason that a stock split should make a stock more valuable. But it became a speculative kind of siren song for investors back in the 90s. And it was really interesting to see that happen again with Nvidia. So Nvidia announced earnings and then announced the stock split, and the stock just took off afterwards. We saw the same thing in Broadcom. When Broadcom announced earnings, only a week or two later, and the stock did the same thing. I mean, the revenue growth and guidance were not, anything that analysts hadn't really anticipated beforehand, and especially the guidance. And they announced a stock split, and stock goes crazy to the upside. So yeah, there's a lot of speculative activity out there that is something that we haven't seen for a long time.
During the tech bubble, since for our listeners out there, you were a hedge fund manager managing money back then, was there gamma squeezes or was options activity in stocks, large cap stocks back then, like Oracle or something like that? It just wasn't there, similar to what's happening in Nvidia and Apple now with the gamma squeeze that you just talked about.
Yeah, no, there were, I mean, options activity was a tiny, tiny fraction. Back then, it was a lot harder to get approved for options trading. Today, you can open a Robinhood account and get approved for options trading. And it was a lot harder back then. You had to demonstrate a certain amount of knowledge and experience in the markets before you could get approved. And it also just wasn't as interesting to people as just using margin. We also didn't have leveraged ETFs back then. And so people just pretty much used margin debt back then. Today, people point out that margin debt isn't as, crazy elevated as it was, relative to GDP or something like that back, at some of the recent peaks. But margin debt is a lot less appealing to people today with interest rates elevated, and they have so many other options with these leveraged ETFs. I mean, you can buy, I think you can, a 2x Nvidia ETF, which is just double the price return of Nvidia. It's a single stock leveraged ETF. So why would you ever use margin? And you can, use options too, and anybody can get approved for these short dated options that you spend pennies to potentially make 50, 100 times your money. And so there's a lot of the leverage is not necessarily in margin debt, but it's in these leveraged products, which are being used in a way that we've literally never seen before.
And index funds back then too, during the tech bubble, were also very, very tiny. A lot of people were not putting the majority of their retirement accounts in their 401ks or IRAs or if they're a government employee or a teacher into index funds back then. Over the last 20, 25 years, I would say market dynamics, the structure of the market has changed a lot with index funds.
Yeah, absolutely. I mean, there were SPY and QQQ were trading back then, but they were more like trading vehicles. And Vanguard, I mean, had funds available, but most people were put into like American funds and things that were, actively managed. And that's just kind of what they were pitched to retail investors as the best way to invest your money. And yeah, this move into passive is also something that is something we haven't really seen before. And these dynamics behind a so-called passive fund like this technology SPDR, is something that's totally new too. And really to call this a passive fund is kind of silly. I mean, first of all, it's a sector fund, right? So you're making a sector bet if you're buying or selling it. And then the way that it's overweight, essentially Nvidia and Microsoft now make up more than 40% of the ETF. It's hard to call it passive, but yeah, there are these types of funds that have become, so popular. I think we saw inflows into technology and growth funds last week that were the highest on record.
I think there's three main factors that are different than the last tech bubble. There's been a lot of share buybacks post 2008 with debt, when debt was artificially cheap for 15 years. So a lot of the big tech companies, a lot of the S&P 500 companies did share buybacks with debt. You have the enormous amount of index funds. I would say they're kind of dollar cost averaging and kind of putting in a permanent bid on a lot of those market cap weighted big tech companies. And then you also have the central banks. It looks like a lot of the G7 ones kind of do this coordination post 2008 with rate cuts or balance sheet expansion, some type of liquidity flows. And it looks like all that extra liquidity from, if the European Central Bank decides to cut rates, which they did, a couple weeks ago for the first time since 2019, looks like that extra liquidity somehow ends up in the US stock market too.
Yeah, and there's multiple dynamics that are very different, right? We had no quantitative easing back then, although Greenspan was definitely too easy heading into the dot-com, the 2000 rollover. Everybody was afraid that computers would stop working when 1999 turned into 2000, and as part of that, Alan Greenspan was probably easier in terms of monetary policy than he really needed to be to try and make sure that went smoothly. That contributed to the dot-com bubble, but it was nothing like the trillions of dollars of money printing that we've seen in recent years to directly support the economy and consumer spending. And really, you see that money flow directly into the asset markets. Not to mention the fact that the Fed is pumping that money directly into the Treasury market, when they do quantitative easing, to bring interest rates down and really support asset prices across the board. So, yeah, there's a number of things that are all very different than what we saw back then. What is, I think, very similar is the speculative euphoria, the idea that there is a new technology. Back then, it was obviously the advent of the internet, or the really the wide growing use of the internet. Today, it's this idea that AI is going to lead to a new era of productivity and earnings growth, and support earnings growth like we haven't seen rare periods of the country's history. I think right now the only time forward earnings, long-term earnings growth that analysts estimate was ever higher than it is today was kind of at the peak of the dot-com bubble and in 2021. So you get these periods where speculative, animal spirits push prices so high that the only way that they can be justified is if you do get 10% long-term earnings growth. But it's very, very, very difficult to see that type of earnings growth, beyond a normal kind of, GDP growth. Could typically earnings grow in line with the economy, and it's very difficult to believe the economy would grow anywhere near that for a sustained period.
Yeah, I mean, the statistics on Mag 7 market cap growth, the fund flows into them, I want to just read some of them off. So 50% of the S&P 500 year-to-date gains, and the S&P 500 is up around 15% year-to-date, is solely 4 to 5 of the large cap tech stocks. The total market share of market cap for the U.S. For all of U.S. stock market now, I think it's over 70% of global stock market cap. So that's if you were to look at the European Union stock market, Chinese stock market, Japanese stock market, the U.S. stock markets. Indexes account for over 70% of the market cap. The Mag 7 alone, Jesse, over 15 trillion of market cap. That is larger than pretty much almost every other country's stock market right now. So
Yeah.
I would say if you're looking for value, probably not in the Mag 7 right now.
Right. Well, I mean, Nvidia passed, in the 3 trillion market, passed the total value of the German, the French, the UK stock market. And like I said, it's 3 times the size of Berkshire Hathaway. So, and I read a stat that Nvidia was responsible for 40% by itself, 40% of the gains in the S&P 500 this year. So, you're really becoming reliant on, these companies. And I mentioned about their long-term anticipated earnings growth. I think one thing that may be underappreciated today is they're spending tens of billions of dollars on this AI build out. These have all been really asset-light companies for most of their history, right? They don't need to deploy a lot of capital to roll out Microsoft software. You don't need to deploy a lot of capital for Nvidia, to do what it does. I mean, Taiwan Semiconductor builds all of its chips. Uh, you know, uh, Amazon and Meta, as Meta especially is a good example, has been super asset light, and now all of a sudden, all these Alphabet, they're spending tens of billions of dollars building out these AI data centers, and they're becoming very capital intensive businesses. Right now, all that spending is being capitalized on the balance sheet, but soon they'll have to start depreciating those expenditures, and that could result in huge hits to earnings. In fact, I tweeted an article last week that showed that the depreciation charges of these companies will triple over the next few years, really putting a lot of pressure on earnings if they don't start generating massive revenue growth from all this spending. And there's very little in the way to show for in terms of revenue for all the spending that's going on.
And if I was going to bet on artificial intelligence over the next decade and this data center bill, the next generation data centers, I wouldn't be betting on like Nvidia and Microsoft and Google right here. I'd be looking at the picks and shovels companies, the infrastructure companies, the copper miners, the data center servicing companies, the data center real estate investment trust, the power and utility companies, because like you said, there's going to be tens of billions of dollars, if not more, of capital expenditures that has to go in. I think there's over 10 gigawatts of backlog. That
Yeah,
one
I
of
mean,
the
I absolutely agree with you, and I think that that all of this. I mean, the fact that all this AI data center spending is coming on top of the massive push to infrastructure spending that we're seeing for reshoring of production related to deglobalization. I mean, it's going to put huge demands on natural resources and energy in the continental United States. And so the idea that they're going to be able to just pull this off, and the prices of all these commodities and things are going to stay where they are is wishful thinking at best. The one point I would just make too is you mentioned a lot of the opportunities. I think I absolutely agree. I've been bullish on energy for years. The one I would point out where I think people maybe would get misled is on the existing data center REITs, because a lot of these are built on older technology, and that technology is rapidly becoming obsolete. And they already pay out whatever more than 100% of cash flow in most cases, and are not don't have the cash to invest in rebuilding these things and bringing them up to standard. So I think there's a risk to the data center REIT specifically that is maybe not, this isn't a great thing for those companies specifically.
That's really interesting. I didn't know that they were paying out over 100% of their cash flows. You would think that a real estate investment trust, that they would keep the leverage below that, and that they would mostly just manage that. Maybe they'd have someone else build the data center and then they'd manage it like a oil pipeline company or something.
Yeah. Well, I mean, it's a difficult business to be in, because the value of those things depreciate pretty rapidly. I mean, think about how quickly technology becomes obsolete. A lot of those were built. You think about Iron Mountain and some of the other companies were built basically just to allow companies to store documents, in the cloud or something. And yeah, they're going to be valuable, to keep doing that. But in the day and age where these new data centers are being built with GPUs and things that and Nvidia is selling, that are 10 times more productive than the current technology, the rapid obsolescence of those data centers makes them, I think, unattractive from an investment standpoint.
Well, the next generation data centers also use 10 times more electricity. So if they're going to be more productive, I mean, they're using way more power and electricity than the old data centers. The old data centers were mostly for improving what the industry calls latency and broadband. So that's upload and download speeds for things like YouTube and Netflix. That's streaming, that's software. That's not the type of raw computing power that is needed for advanced artificial intelligence to improve the learning models like we were discussing earlier before we started recording.
Right. Yeah, and I think that's this such a critical point that literally for years, if not decades, energy demand in the United States has essentially been flat. Things have gotten more efficient, which makes demand go down, but then people use more of it, and so energy demand has been relatively stable. But with this boom in these AI data centers that are so massively energy intensive, the demand for energy is climbing in a way that we haven't seen for a very long time. And so that's resulting is a lot of these companies, I mean, Microsoft has promised to be net carbon negative, I think, within, by 2030 at the latest, so within the next 3 or 4 years. The problem is it's going the wrong way for them right now because
Yeah.
they're spending so much on these data centers. And yeah, they're buying up as much green energy as they can. But what does that mean? That means that there's less green energy available for the normal energy consumer. And so what you're hearing a lot of these energy companies doing is, they had coal-powered or fired power plants that were scheduled to be, shut down. And they're having to roll that back and keep those things operating for much longer than they anticipated because they just can't afford to shut down that production. So, net, what's happening is, yeah, a lot of Microsoft, Amazon, they're buying a lot of green energy, but they're also making sure that a lot of this not so green energy stays on the grid, just because the demand for energy is becoming so intense.
And Microsoft is committed to $100 billion 5 gigawatt project with OpenAI. And I think Nvidia may join at some point to build out this massive next generation data center by 2030. So it's going to be enormous. I don't think they've started construction on it. But the point you brought up, I mean, the Biden administration, the last 12 months, it seems that they've done a full 180 on nuclear energy. And now in the last month or so, they've just approved a couple $1 billion to either reopen or keep open existing nuclear power plants here in the U.S. I think one in Michigan, and then I can't remember which other state the other one was in.
Yeah, and I think what we're going to see is I think the most rapid way to roll out new energy production and not intermittent production. I mean, the green stuff is terrific, but it's not reliable, right? I mean, the sun doesn't shine at night and the wind doesn't blow all the time. And so, a lot of it's great for adding incremental energy, but for really kind of, steady
Baseload.
production,
Yeah, we
you
call it
need
baseload. Yeah.
you need something more reliable. And I think that's going to create a boom in demand for natural gas fired plants in the short run because they're just so much that, we have so much natural gas production in the country, and they're finding ways to make that cleaner and cleaner every day with carbon recapture technology and different things. And so I think that the natural gas is one area that I'm really interested in right now.
Yeah, I agree. I think natural gas is a nice bridge fuel until nuclear power and nuclear energy, it becomes easier to permit and improve. Maybe we switch to next generation small modular reactors, but the current permitting process in the U.S. to build new nuclear power plants, I think the one in Georgia, it came in over budget. It was not on time and on budget. I think it came in over budget by well over $10 billion. I think it was projected to cost about $10 billion, and I think it cost around $30 billion.
Yeah, and I think that's what we're finding, especially with a lot of the green technology is that and you've seen this around the world, is there have been contracts put in place to build a new wind farm, and by the time that it's built, it's way over budget, and a lot of that's just due to inflation, right? We've seen prices of everything go up prices of all the raw materials, not to mention labor and all these things. And so, yeah, it's going to be a challenge. And a lot of these projections in terms of energy usage and whatever were all created before this demand for AI data centers was really took off, and it's such a significant source of incremental demand that it's literally throwing a wrench into all of the models for everything. And so I think it's going to be, one of the things I think that's most interesting about this whole situation is the energy stocks over the past several months. The AI stocks have boomed, right? We talked about Nvidia and Apple and Microsoft and whatnot. But at the same time, energy stocks have gotten hammered. And they've really sold off a lot more than you would expect relative to the oil price. I mean, the oil price is right back up. It took a little nosedive around the OPEC meeting and came right back up and recovered all those gains. The stocks haven't. And so what's going on, I think, with oil and the energy stocks is people are worried about a recession. Well, as my friends at Gehring and Rosenzweig pointed out, in most recessions, we don't really see energy demand go down very much at all across the board. Even in the Great Recession, it didn't decline very much. And at this point now, they've already kind of fully discounted a recession, even while we're seeing demand for energy, for electricity, and for fossil fuels hit new records. And so it's fascinating to me to see the energy stocks pricing in a recession where, a recession that would see demand drop significantly when all the evidence points to just the opposite. Even when we get a recession, demand is going to continue to power higher, and it's not at all bearish for the stock. So I think there's a real opportunity in energy stocks right now.
Yeah, I totally agree. I think oil and natural gas companies, you're seeing them actually, a lot of smart investors, whether it's the oil and natural gas companies themselves, start to do mergers and acquisitions, or people like Warren Buffett. I think the only company that Warren Buffett is aggressively buying shares of is Occidental Petroleum lately.
Yeah, I mean, and he's been selling his Apple, right? Buying, a ton of T-bills and pouring money into, I think he's bought $500 million worth of Occidental Petroleum so far this year. I just tweeted an article. Carlos Slim, Mexican billionaire, has been buying PBF Energy, which is an oil refiner with a big refinery in LA. You're not going to build a lot more refineries in LA, even though demand for gas is as big there as it is really anywhere. And so it's interesting to see that the smartest of the smart money. These two guys are two of the most successful investors on the planet. And really, they're just pouring any excess cash they have into energy stocks.
I think there's been about $230 billion worth of mergers and acquisitions in the oil and natural gas space globally. So there's been a lot. I mean, ConocoPhillips just put in a large bid for Marathon Oil. ExxonMobil just completed the acquisition for Pioneer Natural Resources in the Permian Basin. There's kind of a fight right now over the Guyana assets between Chevron and ExxonMobil. So I think there is, like I said, the industry is looking at adding more assets for future growth. So the industry themselves is not getting credit for it. I think I know you track insider buying or insider selling. I think there's a lot of insider selling. On a lot of the big cap tech companies that we talked about earlier, the insiders are offloading Nvidia and other shares. Is there insider buying in these oil and natural gas companies too?
Yeah, it's mostly, I think, seeing Buffett's buying in Occidental is the most notable that comes to mind. But I think there's been a couple directors that have been buying some ExxonMobil as well that I've seen recently. And there was a fair amount of buying in the natural gas stocks until very recently, when natural gas was kind of bumping around at its lows. Comstock Resources and Devon Energy were two that came to mind where that had some decent insider buying over the past 12 months or so. But yeah, it's interesting to see that executives there are bullish and buying shares. Meanwhile, you have Jensen Huang and the rest of the insiders at Nvidia selling shares like they have never done in the past. But it's not just there. Michael Dell has I think been selling a ton of Dell stock, one of the beneficiaries of this AI boom in the past 6 months. And I've seen it in the semiconductor space generally, where you see a fair amount of insider selling. it's become, the one of the largest sectors in the market, and it's the valuations are obscene. I don't think semiconductors as a group have traded anywhere near the current valuations in the history of the technology.
And there could be a huge oversupply of semiconductors coming online in the next 5 to 7 years. A lot of it's because of the CHIPS Act. I think there's over 70 semiconductor foundries or fab units either going to be expanded or currently under construction now that are supposed to be coming online. I mean, that's an enormous amount.
Well, that's the history of the sector. Is it's an absolute boom and bust sector, because when you have a boom like now, people don't just order, let's say I need 10 of these Nvidia GPUs. I'm not going to just order 10. I'm going to order 20 or 30 of them so I can hopefully try and get 10. And so you get the double and triple ordering, and then which makes demand look unbelievable. And then all of a sudden, people get the chips they need, and then they start canceling orders. And so you get that massive oversupply. And I think we're already starting to see that. There's a lot of AI researchers. I shouldn't say a lot. I've seen a few suggest that while it was very difficult to find access to chips a few months ago, today a lot of the companies that have bought up the chips and are selling, access, to the processing, are going to all these AI researchers and offering them, deals on utilizing the chips. And so I think that we're already at that point where there's potentially more, supply than there is demand currently.
That's funny because look at all the semiconductor foundries that are either going to be expanded, existing ones, or ones that are under construction now. So I know the industry is only focused, like the semiconductor chip and artificial intelligence, it's only focused a year or two out. But like 5 to 7 years from now, all these projects are funded. A lot of it's because of the CHIPS Act. Looks like there's going to be huge oversupply in the next 5 to 7 years of semiconductor
Yeah, I mean,
chips.
we're absolutely investing in the supply of chips like we've never seen before. At the same time, we're cutting off demand by the US saying you cannot sell chips to China, and those restrictions are only going to grow as part of the geopolitical rivalry that continues to build. So at the same time, we're massively investing in new supply. We're actually cutting demand potentially in a big way for these companies. And that was one thing that Jensen Huang warned about a year ago. He said, if we are going to invest in production of these things at the same time that we're cutting off our ability to sell them, we're going to have a real big problem on our hands down the road.
Yeah, I agree. It seems like it's all about timing, a question of when and not if.
Right. Yeah.
So I want to transition now and ask you about these other G7 central banks, whether it's the Bank of Canada, the Bank of England, which traders are starting to bet on will cut rates. I think again in August, I think the bets are increasing that there's an August rate cut for the Bank of England. The European Central Bank just cut rates for the first time since 2019 in the last couple of weeks. Do you think that these governments and central banks, have they hit a limit on the interest rates that they can afford for interest payments on their debt, and that's why they're cutting rates?
I think that I mean, the economies around the U.S. economy is kind of been the bright light around the world over the last couple of years, whereas other economies have slowed dramatically, and so I think they have a little bit more cover to start cutting rates. Whereas inflation has remained a problem here, growth is strong. It's really difficult for Jay Powell to come out and really talk about cutting rates anytime soon when the unemployment rate is still so low. GDP growth is still, relatively good, and inflation is still above target. And so I think it's just something they can't talk about right now. They can't do, even though they might like to, because I do think the unemployment rate it's not a matter of what I think. It is trending higher, and it's probably going to continue higher. And so, it's a very difficult position that the Fed is in, I think, because if you look at, what we're likely to see over the next, second half of this year, unemployment rate is already rising. We're starting to see a real slowdown in housing, which is really one of the things that's been supportive of the economy. If we see housing employment in the housing, sector start to turn also, that would be a real clear sign that recession is on its way. And so, these kinds of things are, and not to mention the fact that all these consumer-focused companies are saying that the lowest rung of consumers are really, really struggling right now. And they're really only buying absolute necessities. And so, I saw one of the major Wall Street banks say that there's already a recession there for the bottom 50%. It's the top 50% that haven't hit it yet. And so it looks like we're kind of headed in that direction in terms of the economy, but the Fed cannot really kind of start to, address it too soon, especially with inflation still being a problem and inflation expectations being a problem. You look at underlying, inflation expectations and, all of those consumers that are struggling, the bottom 50%, all believe that inflation over the next 3 to 5 years will be 7-8% or something crazy. So to say that inflation expectations are well anchored is just not true, and so that creates a real problem for the Fed. And so I think these are all issues that other central banks don't, that are not really as poignant for other central banks as they are for the Fed.
Yeah, that's interesting. I think there's been a lot of accumulated inflation in the system from not just the Federal Reserve Bank, but all these governments and central banks the last 5 years or so. So the currency creation, it's many, many trillions and it's sloshing around. But then when these other central banks, when they cut rates, he says not as important. But do you think that liquidity, if the central bank, say the European Central Bank continues to cut rates, the Bank of England does cut, is that excess liquidity, is that going to not stay in those domestic economies or their asset markets and is going to end up in US stocks like the S&P 500 or the Mag 7?
To me, it looks like we may have seen a peak in terms of asset flows, and I'm not just talking about like foreign flows, but when you get record inflows to tech and semiconductors and growth funds, driven by institutional money. You have record call option buying driven by retail investors and significant foreign inflows, right? Once everybody is already loaded all on one side of the boat, it's very difficult. I mean, you don't just need incremental money to keep flowing in. You need that to trend, to keep setting new records. And I don't think that's possible. So I think right now we've already seen a crowding on the long side of these things that has reached such an extreme that it just can't push any higher. Like literally, everybody's already all in tech, in AI, and all of these things. You take the passive share, right, which is already record long. Microsoft, Nvidia, and the Mag 7. And then throw in all the money, the record flows into growth and tech, and the foreign flows. And I think we've already seen a peak in terms of crowding in that respect. So anytime that it backs off at all, which I think is what we're seeing right now with Nvidia down 15% in 3 days, is a sign that we've reached a peak in terms of the ability of investors to crowd into something, and it just reached its natural limits, and now it's moving the other way. And once that happens, you're not going to reverse those flows very easily. Part of that record flows into XLK, right? And pushing that fund to buy the Nvidia and types of things is it created an $8 billion inflow into that fund by far away. I mean, 4 times bigger than any weekly flow we've ever seen into that fund. And that was just part of that mechanical transition in terms of the weightings of the top allocations there. That necessarily comes out as an outflow, this week. And so, when you see a record inflow and necessarily creates a record outflow, just based on part of the way that the mechanics work, in terms of market makers helping that fund manage those positions, it's a very high probability of a top in terms of positioning.
So these central banks, if they do cut rates and create more liquidity, do you think that some of the liquidity is going to end up in shorter term US Treasuries? Or do you think that we're seeing a lot of evidence that a lot of these foreign central banks have decided they're not going to be net buyers of Treasuries, and instead they're going to dollar cost average each month on gold tonnage instead?
That's the World Gold Council polled global central banks, and an increasing share of them say they're going to be growing their allocation to gold. And so I think that's what we've seen them do over the last couple of years, and they say they're going to continue doing that. So I think you have to kind of take them at their word that that's what's going to happen. But I think that, what a lot of people think may happen with cutting rates is that it's bullish for assets. But if you look at the history of especially the Fed funds rate, right, the first rate cut is usually a sign that things are starting to turn south. That's usually what gives the Fed cover to start cutting rates. And look at the rate cut cycle during the great financial crisis or the rate cut cycle during the dot-com bust. And rate cuts in that context are extremely bearish. And that's because the Fed is usually behind the curve in terms of what's going on with the economy. Just like they're behind the curve in terms of raising interest rates, right? Inflation was ripping higher, and they just watched it rip higher and said it's transitory before they started raising interest rates. They're going to do the same thing on the flip side, where the economy is really going to start to deteriorate before they start cutting rates. And when they do their first rate cut, that's going to be confirmation to the markets that things have really turned for the worse and that a recession is on its way. And that's going to be problematic for equity investors, because it means that all those earnings estimates for whatever it is, 10% earnings growth next year are going to be thrown out the window, and we're going to see some type of an earnings decline. And so I think it's very a difficult case to make that rate cuts are going to be anything but bearish for asset prices when they do materialize.
Yeah, I think given the Fed's track record since 2008, the financial crisis, the Fed is reactionary and they panic. They do a 180 reversal on policy. You mentioned some of the different ones. I mean, going into they didn't see the 2008 financial crisis happening. They thought subprime was contained. They didn't see the last Fed rate hiking cycle with Jerome Powell, the repo crisis. They didn't see that coming either. They didn't see the inflation that they created with all the lowering rates back down to zero and all the QE programs and currency creation, creating enormous inflation in the 2 years from 2020 to 2022. So it's all been reactionary, and then they do a 180 on the policy and panic. I do not see substantial Fed rate cuts. In my opinion, we might see one or two token ones, but until something breaks, like whether that's commercial real estate, a lot of it, or more a bunch of different regional banks, or a sizable one like Silicon Valley or something like that, or even one of these large foreign banks, a Japanese bank, or something larger than the fifth largest Japanese bank with the problems there, I don't think we're going to see the Fed panic and start to massively cut rates.
Yeah, I agree with you. And I think that you're right to bring up the commercial real estate issue because, if you look at the gold price over the past few years, it's had a pretty interesting, about a 3-month leading negative correlation for the regional banks. And so you'll see gold price strength lead relative weakness in these regional banks. And so if you just overlay that chart, the recent rise in the gold price over the past 3-4 months would suggest that we're at a point in time where regional banking stress could start to materialize again. There's an interesting article in the New York Times today showing that a lot of these banks are starting to sell off loans in their portfolio, realizing that the extend and pretend game they've been playing is not going to work anymore. That you can't just pretend that if we extend the loan terms that this building, that is, in terms of underwater, in terms of, cash flow and whatever is going to somehow turn around in an era when nobody wants to go to the office anymore. And so the fact that they're starting to sell off these loans means these losses on banks' balance sheets are going to start to be realized. And the more that it happens, the more pressure it puts on all the other banks, and you get kind of a negative feedback loop. And I think that might be just starting now with some of these, sales. And so if that's the case, then we could see the issues in regional banking, crop back up again. I saw an interesting report today that suggested that, there's just a huge swath of the regional banking world that's essentially insolvent. If you mark to market assets, that essentially the entire regional banking sector is insolvent. So that's, to some extent, the stock market has been playing an extend and pretend game with these companies that, okay, you don't have to mark to market. So we'll pretend that you're solvent. But if these companies are forced to sell off loans, then that game, can't be played anymore. So I think it'll be interesting to see how over the next few months what happens with the regional banking sector.
Yeah, I agree. There's definitely a lot of cracks every day, but we're not seeing any major bank, a sizable one, similar like First Republic in 2022 or Silicon Valley Bank, regional banks of that size look like they need bailouts yet. So Moody's, I think, the ratings agency, I think they just downgraded five or six more regional banks in the last couple of weeks. So that's another red flag. Wasn't there a AAA rated paper in a commercial real estate mortgage-backed security that everyone said was super high quality? And that one, there's losses on that too. So that's similar to what the subprime crisis of mortgage-backed securities from 2005 and six, right? Some of the cracks from there.
Yeah, absolutely. And it won't be until, you start seeing. And yeah, and not to mention that, private equity funds, private real estate funds, and things that have stopped paying out, paying investors, and limited withdrawal redemptions. There are a lot of signs out there that there's a good amount of stress. If those start to grow, that's when you'd start to see, it reflected in the broad markets. And so that's something I'll be keeping my eyes open for the next few months.
Well, the commercial real estate news itself is bad. I don't know if you follow some of this stuff, but it's almost every day in a major city or metro area, there's an office building or a hotel or something like that that's downtown where there used to be a lot of tourists and now there's no longer tourists due to crime or people don't work at the office building anymore because people work from home or the bricks and mortar retailer or restaurant is closing locations. And so like these insurance companies, these pension funds, it's not just regional banks. The insurance companies are heavily invested in this too. So are the pension funds. They're selling these things for all cash. They're willing to take a larger discount if they can liquidate it and get all cash.
Oh yeah, they're selling them for, 60, 70, 80% below what they paid for them just a few years ago. I mean, it's amazing how, just rising interest rates and rising vacancies in these things just absolutely decimate the value of the assets. And so, as of right now, you have a lot of these real estate companies are still, making payments and they're not refinancing the loans at higher interest rates, and the banks are happy to let them do that to kind of extend and pretend, as I said. But if it's the case now that a lot of these banks are realizing that, hey, we need to just sell this off. This is never going to work out for these companies, and they're never going to turn this building around or this hotel around, whatever. Then realizing those losses through the sale of the loans could create like a negative feedback loop, like I was saying.
I want to ask you about the comments that Stanley Druckenmiller made about the 1987 crash, because it seems that things were bullish and euphoric prior to the 1987 crash. But I see a lot of problems beneath the surface here outside of the asset markets. I see problems with the Japanese bank. I see problems with other currencies against the dollar, with the Japanese yen intervention, their banks. Do you think that something with all the leverage from banks or hedge funds with a yen carry trade or losses on bonds, besides just commercial real estate, do you think that that could cause potentially like a problem in the options market or leverage with hedge funds or banks?
I don't know, in a lot of those things, I mean, that's why they call it a black swan, because when it materializes, nobody really saw it coming, and it's not always nobody saw it coming. But I think in this instance, we can basically make a safe inference that when you had this period post GFC, the 2009 to 2020 period, where everybody in every industry got completely accustomed to 0% interest rates and super low long-term rates, 3% mortgage rates. There are a lot of decisions made that required those interest rates to persist indefinitely into the future. And so now that it looks like interest rates are much higher than they've been in any time in 15 years. And the neutral rate of interest now looks higher than it's been in the past 15 years. The Fed might be able to lower in a recession, but they certainly can't go back to zero without creating an inflation problem again. So, the neutral rate of interest might be 3.5 or 4% today, which means that they can't lower a lot below that without creating an inflation problem down the road. So, I think that you have not just in commercial real estate, not just in the banking system and buying up treasury bonds that yield, 1% and causing regional banking issues in that respect. There's who knows how many different things, problems there are out there based on the fact that business decisions, investment decisions were made under the assumption that interest rates would remain low for much, much longer, for indefinitely. And now that that's not the case, which is, like I said, is why a lot of these banks are realizing we can't extend and pretend anymore. Interest rates are not going to come down to the point where it's going to bail out these real estate companies anymore, these asset owners. That is probably true for a lot of different areas of the markets. I would just make one other point that Stan Druckenmiller has talked about his favorite economist, the most accurate economist he's ever seen, is the inside of the stock market. And that just means the relative performance of the most economically sensitive sectors in the market. That would be, small caps, retail, materials, stocks, these types of things. And if you look at transportation stocks, you look at the relative performance of things, they've plunged. I created an index of these, and they plunged back below the 2022 low over the last few months. That's a very clear warning sign that the economy is not near as healthy as maybe economists or investors believe it to be. The inside of the stock market is saying things are not very good. That's one of the reasons why we've seen these massive breadth divergences, right? Another signal that I track are Hindenburg omens, which are essentially, instances, daily instances in the index, whether it's NASDAQ or New York Stock Exchange, where you have the number of new highs and new lows above 2.5% of all issues traded at the same time the market is at or near a new high. We've seen 25 Hindenburg omens triggered on the NASDAQ over the last 6 months. The next record, and this is the history of the NASDAQ, going back to the 1970s. The second biggest number we've ever seen was October 2007. We had 18 Hindenburg omens. So we just saw 25 over the last 6 months. So this is the biggest breadth warning in the history of the NASDAQ that we're witnessing right now. So that's a very clear sign, I think, that this is a very unhealthy market. And a lot of that unhealthiness is due to the relative strength of these economically sensitive sectors, which has been very, very poor.
And you brought up interest rates on U.S. debt, on Treasury debt, on the 10-year U.S. Treasury debt, and although it is down substantially, it was at 4.7%, I think, a couple months ago. It's back down below 4.3% when we're recording this interview today. Still relatively high, but in terms of currencies, with interest rates where the Fed has set them and the yield curve, that's still a lot higher, and the dollar is a lot stronger than a lot of other currencies. If you've looked at a lot of global financial problems, macro and emerging market problems, it's normally when the dollar rallies too much. So if we continue to see a strong dollar, if the dollar rallies, I mean, that could be a wrecking ball to a lot of emerging market countries. You're seeing this with currency weakness and problems in a lot of other countries right now.
Yeah, I mean, the yen is one, right, where it just continues to weaken. And, I think those problems will be resolved because the Fed is going to, if the economy weakens to the point that gives them cover to cut, that's gonna fix a lot of these currency issues. I think we're getting really close. If you look at the monetary cycle and the precious metals, we've almost recreated this like 2018 to 2022 cycle in the gold price, where Fed raises interest rates, your precious metals correct, Fed's done raising interest rates, precious metals bottom out, and then start to take off to the upside, anticipating the turn in the monetary cycle. That's exactly what's going on today. It's very similar to this 2018 to 2022 period. So what the gold price strength is over the last few months is already anticipating some Fed rate cuts. And if you believe, as I was saying earlier, that the only thing that's going to give the Fed cover to cut rates is if you start seeing the unemployment rate really tick up in a meaningful way and economic activity slow down. That would be a recipe for the gold price to take off on its next leg. But I think that's already what kind of the gold price is telling you, is that we're headed for a monetary turn, but that turn is going to require a turn in the economy to give the Fed cover. So I think that kind of what, gold price is potentially pointing to something like this. It could be regional banking strife. It could be some type of, sign that's clear that we're headed into recession.
Well, a lot of the gold demand increases since really October and November of last year, it's been on central bank outside the G7, non G7 central bank buying, which is dollar cost averaging each month, instead of buying a lot of US Treasuries, which a lot of the governments are not net buyers of US Treasuries. And then you also have huge demand increases from retail investors in China, India, Japan, Korea, and other parts of Asia and emerging markets. So I would say that's driving the gold more than the U.S. because the GLD inflows. The majority of the move in the gold price up. The GLD was actually having outflows of metal.
Oh yeah, absolutely. And I would point out too, one of the vehicles that I use, and I don't get anything from Sprott for plugging this fund, but it used to be the Central Fund of Canada. It's now the Sprott Physical Gold and Silver Trust, has a warehouse full of gold and silver. And it trades at a 5% discount to its net asset value. I don't know anywhere else on the planet where I can buy physical gold and silver for a 5% below market price. The fact that discount exists is, evidence of the fact that Western retail investors, Western institutional investors have zero interest in owning the precious metal right now. That is not the sign of a top, right? This thing traded like a 10% premium at the 2011 top, premium to net asset value. So there's been no flows into gold ETFs. There's been no flow. I mean, the discounts available in this closed-end fund suggest that there's zero Western demand. So you're absolutely right.
I think the Sprott Physical Silver Trust, I think it had over an 8% discount. Might have been at one point it got to 12 or 13% discount. I'm not sure what it is. In the last week, I haven't looked at it. But do you think, are you surprised that there's so much bond market volatility versus stock market volatility in the VIX? Because it seems like the VIX doesn't move at all. It's stuck around 13.
Well, what's going on with the VIX? I mean, I'm not surprised with the bond market volatility, right? With the Fed doing quantitative tightening at the same time that the growth in issuance of treasuries is just surging, is creating, should logically result in volatility in interest rates and bond prices and these things. But what's going on in the equity market is you have, this a few different dynamics, and one of them is just the popularity of, essentially volatility selling funds, right? So whether it's covered call funds, or funds that protect to the downside through spreads and things. There's been so much activity in the options markets relative to the equity market itself that the tail is wagging the dog. As I was talking about before, Nvidia, driving, the stock price, right? The demand for options driving the stock price. I think the same thing is going on with the VIX right now, where the VIX should tell you, implied volatility for the stock market, but it really just tells you, demand for a lot of these, options related products, which is just off the charts. There's a good article in the Wall Street Journal today about this, how a lot of baby boomers don't want to reduce their allocation to equities. They want to keep it, at 80, 90% in a lot of cases, which goes against all, financial planning advice you might get. But so what they're doing is they're using a lot of the, covered call funds and things, whatever, that buy the underlying stocks and sell calls against them. And that the selling of options, dampens volatility. You also have, like and I'm no expert on this by any stretch, but there's a trade going on among institutional investors where they're trying to arbitrage the difference between index volatility and single stock volatility. And so there's tons of volume in that trade going on that also dampens volatility. And, every time we see these episodes where there's a lot of essentially short vol trades being put on, they eventually blow up in one way or another. We saw it with Volmageddon in early 2018. And we could be heading for another such episode because, volatility is clearly depressed. Another indicator that I watch is the correlation, 10-day and 10-week correlation between the S&P 500 and the VIX. When that turns positive, right, when you get the VIX the S&P 500 moving higher and the VIX moving higher over a 10-day period, when that turns positive, it's usually a pretty good little short-term sell signal, not always. But when you see that over a 10-week period, like we have this year, and same thing in the NASDAQ 100 and the VXN, which is its volatility index, it's usually a really good sign that volatility is getting ready to pop to the upside. We saw that right before Volmageddon. We saw that right before the COVID crash in 2020. And we're seeing it again over the past couple of months, where volatility is going up and stock prices are going up, and things, it shouldn't work that way. It's a sign that potentially under the surface, the smart money is buying is starting to buy protection, and vol is essentially the downward trend in volatility is potentially reversing to the upside.
And we didn't have a bond bear market and big losses on treasuries, commercial real estate, high interest, variable rate consumer debt, auto loans, those things before. So you add all those things in, looks like the banking system and a lot of the hedge funds that did these leverage trades, whether it's the leverage short volatility trade, risk parity, the basis trade, these leverage bond trades. I mean, there's a lot of losses there that I don't think are being marked to market yet.
Yeah, I mean, I think right now in this, volatility arbitrage trade, I think they're making a lot of money on it right now. But, it's really, difficult to make the case that it's smart to be selling volatility with the VIX, where it's at, right? 12 on the VIX, right, is about as low as it ever gets. We've seen single digits on the VIX in the past around, Christmas time and things, but to be essentially short volatility when volatility is bumping around, its all-time lows is not necessarily a great risk reward. And so I think that's, what's going on with a lot of these trades. And I think what a lot of people don't recognize either with a lot of these covered call things is it's never been a good trade in my mind. I mean, because you generate income, right? And a lot of these funds say, are advertising 8 to 10%, essentially dividend income on the ETF. But you cap your upside, right? So if you own Nvidia and you're selling calls against it, you're not making any of the upside because the stock keeps getting called away from you. At the same time, you're not protecting your downside, right? So you're generating maybe 8 to 10% in this dividend yield, but you're still holding all the downside risk. And it doesn't take. I mean, Nvidia has wiped out 15% of your dividend yield in 3 days. So there's a potential for problems in a lot of these things.
The VIX too. I mean, if I remember correctly, the VIX didn't do anything from about 2009 until Volmageddon in 2018 or 2019. But then finally, after almost a decade, it finally started to blow up hedge funds and other funds that were, I think it was preceded the repo crisis by about 8 months in 2019.
Yeah, and we also, a lot of people forget that we had the Volmageddon in what was January, February 2018. And then we had, some of these significant breadth divergences and things like, like I was mentioning before with the Hindenburg omens. We did see in the summer, early fall of 2018, another period of a lot of these breadth divergences, like I was mentioning before. And people may not remember that we did see in the fourth quarter of 2018, stock market fell 20% in the quarter. And so, it's there are a lot of warning signs right now, whether it's, the speculation in volatility, it's the breadth under the surface. There's or just the fact that interest rates are going to remain elevated, and that continues to put problems on things like commercial real estate. At a time when unemployment rate's already rising, there's a bunch of things that could go wrong right now, and the market is certainly not priced for it.
Now, I know you look at financial history. Have you seen stocks continue to go up when there's a long-term bond bear market?
Well, right now, if you look at the real interest rate, you can use the 30-year TIPS yield as a proxy for that. It's around 2%, which is basically kind of where it was before the financial crisis, right? It fell during the post-GFC time period as a result of monetary policy and whatnot. But a 2% real yield on a 30-year TIPS suggests that the price to earnings ratio for the S&P 500 should be below average right now, or should go back to like the pre-GFC average, which is, a lot lower than it is today. And if so, what that tells me is that investors in the stock market are either betting on real interest rates coming back down to that, zero or negative kind of area where they were from 2009 to 2020, or the stock market eventually needs to reprice lower to reflect the persistence in higher real interest rates. And I think that's probably the case, that I still think that, this mindset, and I mentioned it with the regional banks, I think a lot of this extend and pretend was related to the fact that so many people, and you see it with companies who are needing to are facing a maturity wall. They've all been kind of waiting to refinance a lot of debt in hopes that interest rates are going to come down and give them the chance to refinance at better rates. But if rates don't come down in a meaningful way, like we get a recession and the Fed lowers, to 3.5% or something, and long-term rates don't really come down much and stay in the threes, people are going to realize, wait a second, we're not going back to these interest rates that we saw with, below 1% on the 10-year that allowed us to refinance at crazy attractive rates. And if that's the case, that realization, that's forcing regional banks to say, we got to sell off some of these loans in our portfolio, could force a similar realization among equity investors that, wait, okay, valuations in a world of higher interest rates, equity valuations need to be lower, significantly lower than they are today. And there's a really close relationship, in fact, that Mike Green has pointed out, that with real interest rates and the price to earnings ratio on the S&P 500, and right now it suggests that price to earnings ratio is way out of line with where interest rates are. And so if there is that realization among equity investors, it means that the price to earnings ratio, the valuations of equities, has to reset at a significantly lower level than where we are today.
Well, if you remove Mag 7, isn't the price to earnings ratio for the S&P 500 around 18? So it's mostly just the Mag 7 that's distorting things.
Well, you have to look at that price to earnings ratio. So take that out. And then what you're probably referring to is the forward price to earnings ratio on operating earnings, which is a metric that has only been popular for the last 20 years, right? It used to be that let's do a price to earnings ratio, we do it on net earnings, right? Not on operating earnings. And so if you look at on net trailing earnings, we're something like 25 times earnings on the S&P 500 today. And historically, we're around 15 over the long term. So that gives you some idea of where, valuations should be. The other thing is, profit margins are at their highest levels in history today. And as my friend John Hussman has pointed out, that is almost entirely due to interest rates. And so a lot of these companies were able to lock in low interest rates during the 2020, 2021 timeframe. But as a lot of that maturity wall approaches and companies have to refinance at higher interest rates, profit margins are going to come down in a significant way. So if you're just looking at a PE ratio today, you're and using that to forecast future stock prices, you're assuming that profit margins are going to remain at record levels indefinitely into the future. If profit margins come down because interest rates are going forward, are going to reset at a higher level, then you have to factor that into your price to earnings ratio too. So if you normalize for profit margins, and assume that profit margins are going to go back to a historical average, then the stock market is, anywhere from 50 to 60% overvalued. We're essentially trading 40 times earnings when you normalize for profit margins.
Yeah, the market's hoping for more central bank liquidity or rate cuts or some type of juice to knock it back up, because the AI bubble is not going to benefit a lot of these companies. The other thing with the general stock market, Jesse, and we've talked about this too, I don't think anyone's done a study showing all the trillions of dollars in share buybacks since 2008, when the Fed initially cut interest rates close to zero and kept them that low. I mean, there was many trillions of dollars of share buybacks over the last 15 or so years.
Yeah, and that's another thing is that people don't necessarily appreciate is that and that's largely been from the Mag 7, right? I mean, you've seen Microsoft, Alphabet, Apple's been a huge buyer of its own shares, to the tune of $80 billion a year, something like this. Apple's out of cash. I mean, Apple has cash used to represent 25% of its market cap. It's now like 2% of its market cap when you net out the debt on the balance sheet. And so now that these companies are investing massively in Capex, right? They used to be asset light. So they generated tons of free cash flow. They could use that to buy back stock. Now they're trying to buy back stock and invest, tens of billions of dollars in this AI infrastructure. Something's going to have to give at some point, and the buybacks are going to be the thing. If they're all competing in this AI, I mean, that's something that investors don't appreciate either, is these all companies had their own kind of business silo and didn't really compete head to head. Amazon had its niche. Meta and Google were both in advertising, but YouTube and Instagram, didn't really compete directly. Microsoft has its own niche with the, office productivity software and, these types of things. Now they're all getting into AI and they're competing head to head with each other. It's a zero-sum game, and the profits are going to accrue to one at the expense of the other. And so, a lot of these dynamics are going to put profitability at risk for these companies that are the most profitable in the market. And, if buybacks are only made possible by those profits, then you could see buybacks begin to come under strain as well.
And this reminds me of studying like the gold rush in the past from hundreds of years ago, like the 1850s gold rush, either in California or the one in Alaska or Canada, where it was the people who built the boom towns around there and sold the picks and shovels to the miners. So I think it's going to be like the copper miners, the nuclear power uranium miners, the utility companies, the natural gas pipeline companies that build a pipeline to where the data centers are going to be built. I think those companies are going to be more of a beneficiary in this CapEx, capital expenditure and infrastructure boom over the artificial intelligence companies. Because didn't you post an article you put on your Twitter in the last couple of weeks, the majority of artificial intelligence investments by a lot of these tech companies, not just the big ones, but the small tech companies, they're producing like almost zero return on investment for artificial intelligence projects.
Absolutely. Sequoia, the big VC firm, put out, some statistics on the topic where they showed that, and I think this was just through the first, 9 months of the kind of the AI boom, that there was $50 billion spent on AI infrastructure and only $3 billion in revenues generated so far. And so, I mean, that's a problem, right? Think about, these companies, right? Adobe has said, they're trying to integrate generative AI into Photoshop and these types of things, but they're not able to charge any more money for the products. Microsoft is trying to charge extra money for Copilot, but so far it doesn't look like they're getting a whole lot of takers. Obviously, a lot of these large language models are free. There's a free version of ChatGPT. You can pay for upgraded versions. I personally like Perplexity AI. I use it all the time, and it's totally free. And I think it's way better than ChatGPT. So I think it's going to be difficult for these companies to generate the kind of revenues to justify the spending. And the fact that they're becoming so CapEx, capital intensive, means that what they've been able to do in terms of profitability and buybacks and these things over the past 15 years, they're just not going to be able to do going forward unless they find some huge cash cow in the AI world of AI, which is what they're all looking for. But there's no evidence that they found it, and that it just is such an obvious parallel to the dot-com bubble, right? All these companies spent massively on infrastructure, right? Which is why Cisco, right, stock was the Nvidia of the 1990s boom, because everybody had to build out the networking infrastructure. Global Crossing was putting down fiber optic cables across the ocean to try and make sure that internet could be connected all around the world, and it was an unbelievable amount of spending, and it didn't really turn up much in the way of revenue for a very long time. Right, you had a lot of companies go bust for that reason, which is why VCs are, looking at these companies and saying, I think VC funding for AI startups is down 70% already in the last few months, because they're realizing there's just not a lot of good revenue models out there.
Well, especially when you have really high capital expenditure bills on infrastructure and fixed assets, and your energy costs are going crazy. Those of us who are connected to commodity miners like copper miners, gold miners, silver miners, or oil and natural gas companies, I mean, those companies, the producers of the commodity, if you go and look at a chart, whether it's the commodity price, the copper futures price versus the copper miners index, the ETF index, the copper miners have drastically, except for the last couple months, have underperformed the index. I think the copper miners' returns of the last decade are close to zero, whereas the copper price, here we are, it's around $4, a little under $4.50 a pound. I think it's correcting a little bit. So basically, if you bought and held copper miners, you underperform the real inflation rate, you underperform the copper price because the copper miners had to deal with all that capital expenditure, maintenance capex, their costs rising, ore grades falling, labor costs going up, all those things. So it's looking like the tech companies are going to be having an enormous amount of higher costs, capital expenditure bills that, like you said, they take away from profit margins and free cash flow.
Well, I mean, one of the simplest, I guess, kind of frameworks you can use, and I think not just simplest, but the most effective framework you could use in terms of long-term investing is just the capital cycle, right? When capital flows into a space, returns going forward come down, right? Bunch of capital comes in, creates a bunch of supply, and prices come down. And then it ends up, returns come down and investors starve it of capital. And so supplies are constrained and prices go up again. And so you could see this throughout the history of the capital markets is that, when there was massive capex in the internet space in the 1990s, and those stocks went nowhere for 15 years. If they didn't go out of business, they made no money for 15 years. Intel is still in the red from 25 years. Cisco, has been a terrible investment for 25 years. You saw that with the energy space, right? In the wake of the great financial crisis, interest rates came way down, and who was the beneficiary of all that cheap capital? The energy stocks that started, companies that started fracking. They invested a massive amount into energy production. What happened? The oil price crashed. But those companies have been starved of capital for the past decade, really, since the oil price crash. And so now returns are starting to look terrific, and still nobody's interested in the stocks. But until you get a huge influx of capital into the hard space of hard assets and commodities, this bull market is not going to be over. But on the flip side of that, though, where is all the money flowing? Where's all the capital flowing? It's flowing into AI. It's flowing into tech. We're seeing this huge capex boom, which will necessarily depress returns for all of the companies involved for years to come. And that's just the nature of markets. And so we're going to invest in massive oversupply of data centers and all these kinds of things. And so the returns on all that spending is going to necessarily come down in a very meaningful way. And so, the lesson from that is look for areas that have been starved of capital. That's where you want to invest. And, the real assets, hard assets, whatever you want to call it, commodity sector has been starved of capital for a decade, which is why returns are so good there. And it's why, as we talked about earlier, these billionaire successful investors it's the only space they're interested in right now.
And valuations are cheap, and it looks like there's going to be some growth with copper miner, silver, energy, the baseload electricity, uranium mining, and nuclear power, and then gold. The gold demand for retail investors outside the United States, the non-G7 countries, they want to hedge their currency risk and currency debasement and inflation risk. Other central banks are buying gold. So it looks like there's going to be strong demand growth there. And I don't see a lot of investments into a new copper mine. I mean, it could take well over a decade and $1 billion or more for a medium-sized copper mine. It's not even a large copper mine. So the copper price would have to stay high for many, many years. I do not see a lot of banks and pension funds willing to invest billions of dollars into new supply for copper or other key metals to fund these data centers and infrastructure yet.
Yeah, well, it's going to take prices moving well higher for a prolonged period of time to inspire the type of capital investment that you'll see to really drive the growth in supplies that we need to really make the AI boom possible, to make the reshoring of production possible, to provide the raw materials for a renewal of infrastructure, and all of these things. I mean, there's so many multiple trends in place right now that are just bullish for the commodities space. That it's hard to imagine a more brighter environment.
And there's also mergers and acquisitions in oil and natural gas producers. Like I said, I think there's around $230 billion of deals in the last 12 to 18 months. So there's a lot in the US and Canada. And then you're starting to see insider buying for the gold miners, and some mergers and acquisitions pick up a little bit recently too in copper and gold.
Yeah, and I think, when you look at what's going on with just asset flows too. I talked about capital flows, but on the flip, it's very similar to that is the asset flows and what's going on in the commodity space. You see insiders and the smart money, the billionaires, billionaire investors buying in these sectors that have been starved of capital. And this flip side, you see, these sectors where massive capitals flowing in, creating very poor returns. You see, retail investors are piling in like they've never done before, and insiders are selling hand over fist. I mean, like I said, Nvidia insiders are selling. The sell to buy ratio. To just kind of quantify this. I track the 12-month sell to buy ratio, total dollar value of sales versus buys is now is now tied right now for the highest level that I've seen in the history of the data over a decade. That goes back to, the 2012 or something. And, the only time it's been this high was in November of 2021, right before the 2022 bear market. And so insiders are about as bearish on the broad equity market as they've ever been right now.
Well, Jesse, I really enjoyed our discussion today. We'll have to have you back on again in a few months. You are a wealth of information. Please tell my listeners more about the Felder Report.
Yeah, I publish a weekly blog post at thefelderreport.com. It's just kind of a highlight of 5 of the best charts or articles that I found during the week. I'm pretty active on Twitter. It's just at Jesse Felder, or I guess X is what we call it now. But yeah, so the post that I put out weekly is basically just highlighting the 5 things that I found and tweeted during the week that I found the most valuable. In the last couple of weeks, I've focused on Nvidia because there's been some really interesting dynamics going on there that aren't nearly as bullish as people as the stock price would indicate until the last couple of days. So if you're interested in something like that, it's just thefelderreport.com. You can sign up there on the homepage.